Thanks once again for joining us. This breakout section has been brought to you by dxFeed, dxFeed.com. And I work there as a lead quantitative analyst. My name is Anton, and I'm happy to be here, and I'm happy to be a part of a company that shares our values when it comes to academia achievements. And we hope that this talk will benefit greatly to the financial community in general. With me, I also have here today in the audience a co-author of mine, Dmitry, and we've been working together on this piece of research that I'm about to present. The topic of this research is iceberg order detection and prediction. Here's the details of the talk. It is and of the research piece as well. So here you see the link and the QR code that also leads to that link. This research is now published ahead of print in a journal called Quantitative Finance. I'm sure some of the members of the audience know that journal well. It is accepted and is being published online. We also have a handful of print copies available on request, so feel free to ask to request those, and we're happy to share them. If you type in the CME or iceberg order detection and prediction, the search engine will likely spit out the preprint or fairly outdated version that we posted a while ago on archive.org. So it should be noted that this version is a bit outdated at this point. But still, you can see that those links are there, and once again, feel free to ask for a more updated copy. Now, this research that deals with a specific area that is called microstructure, that has received significant attention over the past years, and it keeps building that momentum. A great entry point to this whole world would be a book called Trades, Quotes, and Prices by Bouchot and his co-authors, and Professor Bouchot also will be leading a session later today, so that's very neat, and we're looking forward to participating there as well. So why do we? What's the subject of this research? It is a hidden liquidity. And we know that hidden liquidity is relatively new, and there exist modern techniques to hide and distribute liquidity and hide the trading intent from other participants. Now, why is that? Why does that happen? Because there are known well-established phenomena like price impact and front-running strategies that are also mentioned briefly in this book above. And it is known, it is common knowledge by now, that it is not very favorable for everybody, for the market participant, to show the full intent, the full trading intent, and to submit an order that is of a significant volume that would be not very favorable to her average trading price. That is why hidden liquidity happens, and also an iceberg order, notion of iceberg order appears throughout the years. And here's the research that we have seen, and there are more studies contained within these articles that we see. And especially wanted to bring attention to a piece of Christensen and Woodmansee. They established a similar framework that we're building upon here, and they also among these research pieces, they are probably the only ones that are concerned with building a predictive model. And that's what we also do. So let's go to and see what are the iceberg order types that we're dealing with. First, we see that in these research is concentrated on the CME data, Chicago Mercantile Exchange, and they offer a thing called native iceberg. It's just an order, but instead of just having a price P and a side S and a total volume as usual, it also has a so-called peak volume, where the total volume is hidden from market participants, so it does not get displayed in the order book, and only a peak is visible for market participants. Until the total volume is exhausted, a refill mechanic replenishes that peak, that visible side of the visible tip of the iceberg every time it is fully traded. Like any other order, this order also gets assigned a unique ID that survives throughout this session until this order is completely removed. So that allows for an unambiguous reconstruction of what exactly happens to that iceberg order. There is also a similar service provided by independent software vendors that do follow the same mechanic, and they offer the so-called synthetic icebergs. So they do basically the same, but they listen to the order they submitted and resubmit it once again if the first part is traded. In that scenario, we do not see a persistent ID. There's no possible way to identify these messages through a unique key. And it is arguably, therefore, easier to hide the trading intent. And it is also presumably associated with higher costs, because any market participant that would employ this strategy would have to pay this software vendor to do this. And so we have a financial type of argument that if a market participants would like to hide their intention, they would go either for native iceberg or a synthetic iceberg within the CME infrastructure. The key assumption that is attributed to the synthetic type of iceberg is that a refill will happen at the same level P and at the same price S. So otherwise, it would be extremely difficult to track down the whole evolution of this structure, and I will have an example a bit further down below. It is also should be noticed that there is no ground truth, and nobody, in the case of synthetic icebergs, nobody really knows what is going on and who submitted a specific iceberg, and it is not possible for anyone to discover what were the true sequence of events.
Well, I am another author of the paper. Okay, thank you very much. I think I'll pick up from now on. So indeed, there are two types of icebergs, and the goal is to detect both of the types. And the most natural sort of mechanism to do it, in particular with native icebergs, is to compose a finite state automaton with several states and analyze the incoming order flow so as to change the states of the automaton.
So yeah, just to keep up the progress, there is possible to map the order messages as they come into the order book and to map them onto different statuses. And basically, the discovery mechanism would rely on a finite state machine with these states. And it is technically challenging to reconstruct that, but I skipped the important details so we can fit into the schedule. But these are present in the article. So we had access to an FOD, full order depth, LOB, limit order book historical tapes. And in conjunction with the CME protocol specification, it is possible to detect, run this algorithm against the data that we have to receive the triplets of total sizes, big sizes, and E, where E is the end status. It is either finished and there is no more refills, the iceberg is completely gone from the book, or canceled by user. Now, for synthetic icebergs, this is more challenging since we do not have a firm link between trades and refills. And here we use the idea that was proposed by Christensen and Woodmansee as well, that there exists a delta T, which is the maximum allowed time for refill after the trade, So in that case, if there are no refills, that means the sequence is complete. Otherwise, we join it into a tree structure that is proposed here on the right. And also we introduce a weighting scheme that basically reduces that more complicated situation into the same set where we have basically the same triplets. Now, once we have those data, and once we run that historical analysis and identify those icebergs within the data sets that we have, we may pose a problem or a number of problems here. But we are concerned with the following statements. We first would like to infer the presence of hidden volumes. So basically, it's a binary classification task. And the second would be a regression task when we are interested in the distribution of volumes, the total volume and the peak volume, joint distribution of that, and then trying to infer the total volume by only observing a peak volume. This is a real type, real case type scenario. And we would also would like that model to account for order cancellations, because we have those status and status events. Either user canceled the order or it is fully traded. And to do so, Christensen and Woodmansey, they propose a kernel density estimate. We argue that for this type of estimation, a survival analysis with a right sensor type data would be more appropriate, or at least it would be a good candidate to do so in order to cover the third point here to account for order cancellations. And we have two estimators that we covered in the research article. Now, I would like to highlight results. We have two types of results. First, the detection results and then the prediction results. We had access to an ESU19. It's the E-mini S&P 500 futures contract that was active last summer. So we had a training sample of 3 days, which constitutes 19 million messages. And as a part of the results report, we have some descriptive analysis for everybody to take a look at. It also fits into the previously reported figures that also these researchers also report these numbers. It would be a nice addition to that literature. So here we see that we have for native icebergs, we have about 4% by traded volume, by daily traded volume, that is contributed by native icebergs, and the count is 0.06%, which means that market participants do intend to hide their volume by employing these native icebergs. Synthetics, since it is not possible to identify those sequences unambiguously, we provide a range as here, somewhere between 3 and 14% by trading volume, depending on what parameters are used. This is not a confidence interval, but rather just a broad range of estimates. And also there is a highly visible human bias towards round numbers like 10, 25, or 50, which is also very indicative of human behavior. And for prediction results, we've split the testing and the training sample. The same dataset is used, but it was another day. And we have covered and reported a wide range of scenarios, and the results that are being reported, not only reported as F1 metrics, but also as many other associated metrics. But the numbers are here for native icebergs. We have a pretty decent figures. For synthetics, it would be less. So the prediction is not that great, but it is still better than random guess, and it could be further improved, as we think. And the thing is, we do attribute that loss of precision to the fact that this is a more complicated situation. A lot of icebergs that we detect may be instead false positives. But the overall performance is fair, and we're happy about it, and it could be further improved down the line. So just to conclude our talk today and highlight the most important results. We've been building upon the framework of Christensen and Woodmansee. And what we did in our extensions were we first formalized the distinction between native icebergs and synthetic icebergs within the CME infrastructure. Second, we formalized the detection phase using current modern CME protocol and full order depth data. Then we introduced the models coming from survival analysis that account for order dilutions, which is something that was not previously done. We reported hidden volume estimates within the data that we had for that particular asset class. And our estimates are in line with what was reported by other researchers in the area. And also, one important feature that we would like to highlight is that both detection and prediction are compatible with real-time data streaming sources. They could be easily adapted, not only to be able to process historical tapes, but serve as an online algorithm. Possible improvements, we have quite a few here. We would attract more attention to this topic, and this absolutely deserves it. And some studies are dated, and it would be difficult to try to verify them and derive conclusions because the data is old. The data is also very, very hidden, and it's not very possible to not possible for a general audience to retrieve the data. But still, these numbers are needed for a complete understanding on what is going on in modern financial markets. So more studies across time and assets would be a great addition to the topic. We're also thinking about improving performance further. It would be a good baseline model as we considered it. We also ran some robustness tests, but this analysis is not yet complete, and we would like to add more on that. And we would consider, it would be a nice addition to the topic to consider alternative models here. For instance, we have a few options here that we are currently thinking about. A very close but a different problem could be formulated as follows. What is the probability that the order that we see incoming has hidden volume in it based on the current state of the limit order book? So, for instance, we could use additional information contained in the current state of the order book, for instance, total volume that is currently resting, or any other handcrafted features in order to use that additional information for inference. And that is something that we have already tried to do, and it is fairly successful. So we had a machine type learning models, and we have seen that the competition results that we hosted internally bring a fairly decent metrics. For instance, the area under the rock curve is fairly high, more than 0.8, which is very good. So that's, I think with that, we are out of time, but we've been told that we may stay a bit longer, so I'm not holding anyone, so feel free to stay if you want. Feel free to visit dxFeed.com and all the market service data and associated services that we offer. We've been proud to be a part of the Quant research unit that has Dmitry and me. Feel free to reach and discuss these results. We're also always happy to hear your feedback and maybe engage in potential collaboration on this research topic and many others. So thank you once again. I will try to address some of the questions. All right. Yes, the link to the paper is here. You can see it. It's also as a QR code has been posted also online. Yes, the slides, we can share them, of course, I guess. Yeah, the preprint version should be once again noted that it is a bit dated at this point. It's not considered to be. We have had significant improvements in the model performance and the write-up for the model descriptions. Did you reuse your models for fraud detection? No, not really, but I suppose it could be a good candidate for that as well, because the setting is very generic. So yeah, it could be definitely, if we had a trading sample that highlights what is considered to be fraud, because we need to know some kind of ground truth to be able to run our analysis. Dmitry, yeah, sure, yeah, great. If you have any other questions, please feel free to ask them, whether it be in chat or voice. And thanks for joining in. Thanks for your interest in this.